Most people who try the wheel strategy lose money. And then they go online and tell everyone it doesn't work. But here's what's actually going on: the strategy isn't broken, the way you're running it is. And the five myths keeping you out of this trade in this system are the same five myths keeping most retail traders permanently broke. So let me walk you through all five of them: the recession fear, the assignment horror stories, the whole returns sound fake skepticism, all of it. I'm going to show you why each one falls apart when you actually understand the specific strategy I've been developing for the last five wheels. Not just the wheel, we call it the flywheel. Specific tickers, the rules that separate the winners from the people getting wrecked, and the one thing about the wheel that's actually hard, which isn't what you think. If you've been on the fence about option selling because of what you've heard, this video will clear it all up. Myth number one is you'll get wiped out in a recession. It's the number one objection I hear from the wheel, that you're going to do it and you're going to get hit and you're going to be bag holding stocks that become massive losses. And it's the dumbest reason to not do the wheel, because the fact is, everyone's worrying about it. They're the ones not creating real wealth. And here's the thing: recessions, they don't sneak up on you. You can see them from miles away. Unemployment will start to climb for many months in a row, even before the stock market sells off. Volatility jumps, all this stuff becomes public in the headlines, it's seen on the charts way ahead of time. So when someone tells you a recession is going to blindside you out of nowhere, what they're really telling you is they haven't paid attention to the last four recessions, the indications that kind of lit up beforehand, and the obvious things we can see that tell us things are going to get ugly. And it's time to take risk off the table. And look, when those signals flash, you step out of the strategy. You stop selling puts because the markets, they're falling. All you have to do is pause, wait, and then try to find the exact signals to look for the bottom. The exact signals that showed you the top should be very similar to the ones that show you it's safe again to get into the markets. But listen, this is not a flaw of the wheel strategy, it's basic risk management, which is what every serious trader does anyways. And the other piece of this, the math people don't want you to understand, is the last real recession happened in 2009. So think about that for a second. It was 2 decades ago. The wheel, when you run it right, can produce 60 to 120% returns in a year. So let me ask you something. Are you really going to sit on the sidelines in cash, or worse, dump everything into an index fund for average returns because you're scared? Scared of something that doesn't actually happen every couple of years? More so once every 15? Something that you can actually see coming, you can protect yourself from. That's not a strategy. That's paralysis with better marketing. And let's be honest about what the alternatives actually look like. You either do nothing, which means inflation is slowly eating at your savings every single year, or you dump it into the index fund and you hope the market cooperates for the next decade. And if you're stuck in a recession, well, good luck waiting for multiple years. Or do you try to do the stupid stuff: day trading, swing trading, chasing meme stocks, running the systems that were designed to literally move money out of your pocket into someone else's? Honestly, the wheel sits at the top tier. This beats a lot of the stuff I just listed. It's above index fund investing, and it pays you a meaningful more amount just to start using it. I've done all the strategies, and I can tell you the wheel, it sits on top. It beats index fund investing by a mile, and it pays you in a meaningful, consistent way. You know the money's coming in. You can stay in cash, which makes a little bit more sense if you're worried about recessions. So the big fear about the other strategies is, at the end of the day, you're not really protecting yourself. You're just making sure you never actually get wealthy. Myth number two is you'll get wrecked if you get assigned. That's the second objection I hear consistently. What if the stock drops? I'm gonna have to hold it forever. I'll never make enough money with covered calls to actually make the loss back. And let's break that down. Because look, I get it. The fear is real. The fear is aimed at all the wrong stuff. because assignment on a quality stock is not the same trade as assignment on a garbage one. And there's a massive difference between those two outcomes. When you sell a cash secured put, you're agreeing to buy the stock at the strike price if it drops there towards expiration. That's the deal you signed up for. You're getting paid for that moment. You're either going to get the stock you love at a massive drop, or you're going to just get paid while you wait. It should be a clear win-win in your head before you put on the trade. And here's the thing that most people mess up. Even if the stock's at a loss, if you do own it, if you do get assigned, you can start immediately selling covered calls. Don't wait. The best time to sell a covered call is yesterday. It's free income. You might as well use the wheel the way it's designed to be used. The people who panic about assignment don't actually understand the trade they put on. If the idea of owning the stock at your strike price terrifies you, you should have never sold the put in the first place. Every single comment on the internet about the wheel destroyed my account, guess what they all have in common? They picked a garbage ticker. Too much volatility, too hyped up. GameStop, Iron, CoreWeave, they're meme stocks. They're on social media for a reason. They're at the top of the markets, and they're the ones that are going to get you caught the soonest and ruin your success with the wheel. So here's the one thing you have to internalize. If you get assigned Amazon, Amazon's coming back. It always has. If you get assigned on some hype name that dropped 50 to 70% in the last month because the narrative flipped, you're stuck holding a bag hold that might never recover and make back money for you. And listen, the wheel didn't do that to you. Your ticker selection did. And the trade was doomed before you ever opened it. Now, if you get assigned on a ticker that belongs in your portfolio anyway, a name you genuinely would be comfortable holding long term, what this means is you actually picked the right ticker. And you're probably going to be excited when you own it at a lower price, which is the point of the wheel. But here's the thing most people miss out on. When you get something that's a quality ticker and you're assigned that stock, you're going to have your best months ever having the other side of the wheel work in your portfolio. What this means is if you're just a little bit more patient, you're going to get paid in two ways: from income from the covered call, but also from appreciation from the stock. So instead of making 3 or 5% in a month, the other side of the wheel can boost you to 10 or even 30. So remember, the problem with the wheel is not that you're going to get assigned and it's going to be a nightmare. The problem with the wheel is you're going to get assigned on the wrong stock and it's going to be a nightmare. Because the right stock, it could be a blessing. Myth number 3 is when you go to apply this strategy, it won't work for you. And you've seen those YouTube videos where it looks attractive, 1,000% returns, and then you go to trade that same setup and you lose money every single time. And it seems like a repeat cycle of watching videos and it just not working. But I guarantee the wheel will work for you, especially if you follow these 2 simple rules, which is just having the right implied volatility. You have to be between 50 and 100%, because this is the sweet spot to have the most profit, but also not too little returns, where you run into the big issue with the wheel. Because if you have low IV, sub 50%, Apple, Microsoft, Google, those IVs are way too low. They're going to run you into issues every single time. Meaning you sell a put option and the market drops one day, you're in a deep loss and you're getting assigned at a loss because you couldn't make much money selling that option to begin with. Your strike prices, they're pretty dang close to the actual price of the market. And here's what's happening. If you do get assigned, you're owning that stock at a loss. And then if you ever want to write a covered call, it's the same issue on the other side of the wheel. It takes a single day. You blast past that strike price, and then you're giving up all that money. You're tying yourself up and you're missing out on the upside, which is the more attractive part of the wheel. So low IV option selling is even more dangerous than high IV option selling, because high IV over 100%, then you're in gambling territory. 100% literally means a stock can drop 100% in a single month. So why sell options when the IV is too high? That risk doesn't make it worth it. Do me a favor. If you've been selling options and you're not making money, Just check the last month, year, or last decade of the tickers you've been choosing. I guarantee the implied volatility of those tickers is either too low or too high. Everyone's like, Matt, I got bag held SoFi. I'm still losing with that stock. The wheel doesn't work, Matt. And I would tell you this, I would never use SoFi with our system unless the stars aligned, because 70% of the trades we use with our students are literally the same ticker. We have 3 tickers we repeat every single month. And that's how you know it's a system. That's how you know it's repeatable. And the key here is you don't have to go scan Twitter for the next top ticker or YouTube. You know that your one ticker is going to be the ticker next week and next month. And that is the safety and confidence we want to give everyone, even on this video. Because rule 1 is implied volatility, but rule 2, we're doubling down on the fact that you need to get comfortable owning. So if you buy the triple Qs, congratulations. You can sell puts on them too. And one pro hack, just increase your income and get the IV up to something that makes sense, is take the QQQ and use the leverage form of it. TQQQ. This index fund has been around for almost 20 years. 20 years. Amazing. It's never gone to zero. In fact, it's made new all-time highs. It's been the most robust ticker you can sell puts on. And it's an index fund. It's a win-win. So instead of reinventing the wheel, just use leveraged ETFs on some boring names. That's a pro hack we've taught thousands of students in our option selling program. And I can give you all the secret sauce in the world today, but you have to stick to this one rule, which is don't get bored. Don't switch out your tickers. That's where the wheel fails. You see a YouTuber posting about a trade, move 30% in a day, and you want to sell puts on that. That's too much volatility. If it's hyped up, if it's moved a lot, there's a higher chance you're going to get assigned and be a massive loss. And they talk themselves into breaking the rules that we just outlined today. They talk about high IV, getting into those stocks, and then getting into things they don't truly understand. That's when they get truly smoked. So please, promise me something. You won't get bored. If you want repeatable success, you're going to earn it with the right tickers, with the right framework, and sticking to that for multiple years. When you sell an out-of-the-money option, the stats are right there. They're on your screen. It's public information. The buyer of that option has a 20 to 30% chance of making money, which means you, as the option seller, you have a 70 to 80% chance of profit. It's the exact same trade. Nobody made up that number. They're not trying to sell you a course based off some lie. Truthfully, this is how the math works. Every time you open up the option chain, it's going to say the same thing. So when someone tells you they're getting 5% per month from option selling, it might sound fake, but what they're really telling you is they've never looked at the probabilities, the ones being printed on their screen. You can argue with the strategy, you can argue with me, you can argue with someone running it, but you can't argue with the math sitting right there in front of you. Here's the part most people aren't willing to admit to themselves. The reason consistent returns sound fake is because you've been conditioned to lose money in the markets. Day trading didn't work for you. Swing trading didn't work for you. Buying the dip maybe didn't work. None of it at the end of the day worked from this point on. So now when someone tells you a strategy is working, and more importantly has been working for years, the first instinct is to assume it's a scam, because the entire reference point for trading is losing money. And that reflex right there is the single most expensive bias in retail trading. It's the reason money flows the way it does in this market. Look at the entire financial content ecosystem, the live streams, YouTube videos, CNBC, Discord groups. All of it exists to keep you emotional, reactive, so you keep making bad decisions. And this smart money on the other side of the trade stays that way. Smart taking the money every single week from the ones who are using the wrong strategies. You were never supposed to win playing the game they built for you. The wheel, it's one of the few strategies that lets you play the game entirely different, because 5% a month sounds tiny next to the screenshot of someone turning $10,000 to $100,000 in a single day trade. But here's the trick: 5% a month compounds. Could be 60 to 120% return, depending on your account size, your position size, if you roll your profits into your next trades. But basically, the point is, this is huge. This is beating the index funds at the end of the day in a safe and consistent way without blowing up your account every 6 months chasing moonshots, trying to scan YouTube and Twitter for the latest trades. But most people, they can't stomach boring. Shiny object syndrome pulls them to the next sexiest possible trade with the biggest upside, the most dramatic screenshot they've ever seen. And that's why the same 500 people make all the money in a YouTube comment section, and the same 10 million lose it every year. Boring wins, exciting loses. And the wheel is boring on purpose. Let me give you a real example. I had a doctor come through one of my programs and he walked in with $200,000. He was skeptical, exactly the way you should probably be, but he didn't want to drop his full capital into something he hadn't seen work with his own eyes, which honestly was a smart move for anyone with real money. So he started with $200,000 out of a much larger pool of capital. And listen, his very first couple of trades made money. So he added some. He was at $300,000 within the second week. The next week, a couple more trades made money. So he bumped it to 400K. And a month in, he's at $1 million of deployed capital because that system worked that quickly for him. He didn't know anything about option selling, leveraged ETFs, the proper entry, the proper contract to pick. But he learned that quick, at his own pace, and he saw it working for him. So he scaled in. That's what high income earners do. They stage in, they verify, and once they see it work, they go. They don't hesitate because those returns were real. They weren't boring enough. Most people can't get to that number, but honestly, you need to compound. You need to stop blowing up your account if you're ever going to make anything substantial in the markets. Myth number 5 is this is harder than day trading. And here's the part about the wheel nobody ever warned you about. And honestly, it's the real reason most people quit this strategy before it even starts working for them. Because the hardest thing about running the wheel is not what you think. It has nothing to do with picking trades. It has everything to do with stopping yourself from picking trades that were never supposed to be picked in the first place. If you've ever day traded, you know what hard feels like. You're watching charts for hours. You're stressed out when you're in a trade. You're making dozens of decisions a day. Sitting in front of $100,000 position, swinging up $5,000 or $10,000 by the second. And your heart rate, it doesn't come back down until the market closes. And honestly, you might carry that stress to your family. You might lose sleep over this. So that's one of the hardest hards you can do in the market. Every single day, every single week, you're grinding through it. And the wheel is the exact opposite kind of hard. You place a trade and then you wait. You follow the same tickers you traded last month. You use the same entry criteria. You sell the same kind of option at roughly the same distance away from the price. And then you do absolutely nothing until you hit your profit. And you repeat this. It sounds easy when I say it out loud, but I promise you it's not. For most people, this creates massive amounts of boredom. Running the wheel was never designed to be sexy and fun. And here's what actually happens after a few months of running the wheel. A new ticker pops up on the internet, on YouTube. You're still conditioned to chase new and sexy. It's moving fast, everyone's talking about it, and your brain starts doing the math in the background of what you could make if you got into that trade. If I could just sell one put on that option, what premium could I be collecting? And pretty soon you start building a case to break the rules and get into a brand new ticker. Or the market has a rough stretch and your monthly returns slip. Suddenly 5% a month doesn't feel like enough anymore. You start eyeing more aggressive trades, shorter expirations, higher IV. Maybe you get back to day trading and swing trading. And you start telling yourself you'll do it once, just this one time. And right there is the real challenge of this strategy. The real work is stopping yourself from finding the wrong trade. It's sitting still when every instinct in your body and every content creator on your feed is pushing you to do something. 6 to 12 months of boring, repetitive, disciplined execution on the same small group of tickers is harder than most people understand until they actually try to do it. And every person who has ever told you the wheel doesn't work, they quit somewhere in the exact window where they got bored, they broke the rules, and they went hunting for a trade that wasn't part of the system. Then they lost money and they blamed the strategy. The people who are actually winning with this are not actually smarter traders than the people who lose. They're not running some advanced version of the system. They just learned how to sit still. They followed the same ticker, the same rules, the same process month after month. For long enough, that math finally caught up and started to compound. If you cannot sit still, no strategy is ever going to work for you. Not this one, not anything else. But if you can sit still, if you can handle the boredom of doing the same thing that works over and over and over again, the wheel is one of the most highest probability strategies on the internet. Ones that can help you build actual wealth that exist in the public market that really change the entire game for anybody. Look, if you've watched this whole video, you already know the wheel strategy itself isn't the problem. It's the way most people run it. And if you want to stop being one of those people, or if you want to start running it the right way from day one, here's where I can actually help you. My option selling program is built for people who have maybe over $25,000. That allows you to sell about 3 put options a week. And they're serious about running the actual wheel the right way. Inside this, I will give you the exact tickers we use. I'll let you steal my trades every single week. And you'll get the software to know when the entries are perfect, what tickers are the best this week. You also get a community of traders who are actually executing this strategy instead of arguing about it on Reddit. So I'm not here to pitch you on returns or promise you anything I can't prove, but I can show you the same system that generated most students 5% on average for the last couple months. If you want in, the link is in the description below, or you can go directly to marketmovesmat.com. And that's where the application is. And that's where the real work starts for you. So if you want to learn with us, if you want to win with us, click the link below. Would love to help you, and I'll see you on the inside.